Okay, the question about my profit targets fixed, or would I move them as data comes in? Uh, if I'm trading intraday, they're generally fixed. If it's something that is a swing over a period of days or a few weeks, um, they get the profit targets are a little bit more fluid. There's still a fixed range, but they there's like trailing stops. I don't use a lot of trailing. I use a lot of trailing stops during intraday trades or intra-week trades, but otherwise, it's a good idea to like move your. I guess the easiest way to answer that is that the stop should always be moved into a break-even status or somewhere into profit, but it should still, the stop should never interfere with the ability for the trade to have its own breathing room. I think a good example of that for people who scalp, and if there are those of you who do scalp, congratulations, because I can't. I've never been able to scalp. But scalping is a style where your risk to reward ratio is often in the inverse of what you would normally do. So if you're trading on a daily chart, you're always looking for, let's say on average, a 1 to 3 risk to reward. You're risking 1 for 3. Scalpers do the opposite. You kind of have to have a reward of 1 and risk 3 because you need to allow the position to have enough breathing room to execute. If you're trying to scalp, and if you're going to risk in foreign currencies, if you're risking 10 pips and to gain 10 pips, your 10 pip targets, your stop's going to get hit more often than not because there's just not enough breathing room for it. So all right, I will get started here. So this is a strategy that I'm going to doing these every Thursday at 8. A strategy that I've developed on my own. In my professional training, we had to develop our own methodology and had to make it as original as possible. And I don't know how original it is because it's borrowed from a lot of other analysts and technicians and traders who came before me, but I call it the gap breach, extreme, and cross. And what you use, I probably have the right chart up here. By the way, that was that chart somebody had asked. This is Euclidean geometry in on the New Zealand dollar, US dollar forex pair. That's what this is, Euclidean geometry. There's a couple ways that you can construct these kinds of charts, but in a nutshell, what ends up happening is you end up looking at the kind of natural flow of an instrument, so to speak, similar to how we use and we use the science of astronomy in financial analysis as well, using the pulling data from NASA and Jet Propulsion Labs. We can get these planetary ranges. If I can find, I think I have some example. I should just get to the strategy, but yeah, right here. Here's the pound dollar. So for example, this chart here, these kind of wavy lines that you see here on the GBP USD, the pound dollar. This is the midpoint of Jupiter, Saturn, and Uranus. It's a conjunction, meaning that it's when they're all kind of sharing the same angle. For whatever reason, when these three astronomical measurements are present and you transpose them onto a price chart, they represent the normal, natural support and resistance levels that exist for the pound dollar. So if you're wondering, there's this Wyckoff theory, whatever you want to call it. A Wyckoff method is it seems like every 3 years there's something that retail traders get attached to and get sucked into learning. It's Elliott wave for 3 years, and then it's Wyckoff for 3 years, and then it's something else. But Wyckoff and Elliott wave, for whatever reason, they tend to be the major theories that people learn right away, and they swear that these are the methods that the professionals use and institutions use. In some way, you're correct, but it's what you're not being taught that is to the disadvantage of the retail trader. It's that's what it is. I think a lot of people hear things like institutional and they assume it's of higher quality or of a higher caliber, or it's more indicative of something that is useful, and it's really not. The simple fact of the matter is, if you're trying to take money out of the market, you are trying to take money from people and entities that have a lot more money than you. They can sustain a whole lot more risk than you can, and they can outlast you. It doesn't mean they're smarter. It doesn't mean that they have. I mean, they have more people. They have more equipment. They have more algorithms. They have all these other things. But ultimately, what it boils down to is that they can outlast the individual. All right, they have just a lot more capital. They have whole teams of risk managers. I mean, if you're talking about an even playing field, it's not an even playing field. But life is not an even playing field. So deal with it. You can take money out of the market, but if you think that you are always you versus Goliath, then you'll probably lose if that's your mentality. Okay. Anyways, getting into the strategy. Let's get right to it. I think I had it pulled up in. Let's make sure. Probably had it on point and figure charts. If not, no big deal. Can you hear me okay, by the way? Is music too loud? It should be point and figure. Okay, here we are. So, there are 4 things that you'll need. Okay, the first one is the Ichimoku system. You'll find that in any software has a TradingView. I should just do this on TradingView. I should do this on TradingView. Let's do new chart layout. Most people use TradingView, I think. And let's look at the pound dollar. Okay. Go to the hourly chart. So the first thing you want to get is the Ichimoku system. You can go up to indicators, Ichimoku, type in Ichi. It's going to be the built-in Ichimoku cloud. Once you have that pulled up, double click anywhere on it to bring up the options, and go to style. Get rid of everything except the baseline. That's all we want. And make the line a little thicker so you can see it. I guess that's a personal preference. It's not necessary, but that's personal preference for me. Because the thing that we're going to focus on here is, this is the first part. This is called the gap, breach, extreme, and cross. And the first thing we want to identify is a gap. And that is basically, there's no scientific method for this. Or mathematical method. It's just a kind of a visual. Is there a gap in between the candlesticks and the Kijun-sen, or the baseline. TradingView uses the English translation, which is not really the right translation, but we'll just go with it. The baseline. So if I'm looking at this zone here, all right, if I just kind of highlight it maybe. If I'm looking at this zone in here, does it look like that there's an open amount of space? Is there like a lot of white space in between the candlesticks? Yeah, okay, that's a gap. That's the first thing I want to look for, okay? Like if I'm looking at the pound dollar as it is right now, there is a gap of space in between the Kijun-sen and where these candlesticks are at. So that's criteria number one. Is there a gap? Is there open space in between the Kijun-sen and the candlesticks? Yes. Now, the next part, and by the way, the reason that we focus on that is because within the Ichimoku system and Japanese analysis in general, the Kijun-sen represents equilibrium. All of the components of the Ichimoku system are calculated by taking the extreme high and the extreme low of a certain period, adding those two values together, and then dividing that by 2. That's how the line is plotted. That's why you see the Kijun-sen is a 26-period moving average, but it's of the average of the extremes. It looks a little different than a regular moving average, which is just averaging the closes. So if I take a regular moving average and I'm going to color it purple, a little thicker, and 20. Okay, they're similar, but they're definitely not the same. Okay, just the point I'm making. So the Kijun-sen represents equilibrium. You can, from a day trading perspective, you can think of the Kijun-sen as an oscillating 50% Fibonacci retracement, basically. Price does not like to be far away from the Kijun-sen. All right, it does not. There's a, I call it the max mean. There's only a certain distance that price likes to get before it wants to correct or stay put, and then the market will come back into equilibrium. Now the next one is the breach. Okay, the break. This is another indicator you're going to need, and we're going to change the settings on that one too. These are Keltner channels. If you're familiar with Bollinger Bands, oh, that's not what I wanted. If you type in Keltner, that's what they'll look like. You're going to change the settings by mousing over the name of the indicator on the chart. You're going to want the 20-period average. I'm not sure if that's the default or not. We're going to change the multiplier to 2. All right, so the bands are going to be a little bit more expansive. Hang on one sec here. So just responding to this. It's also giving you time to set your charts up. Yeah, they're a form of volatility. It's a volatility measure. That's what Keltner channels are. It's an old one. Keltner channels predate John Bollinger's Bollinger Bands. Keltner channels were developed in the 60s, maybe. Yeah, I think the 60s. But they predate John Bollinger's work. And anyways, that's what you want. So you want the Keltner channels, a 20-period average, and change the multiplier from 1 to 2. Okay, and so the point of this is do this as well. This is also, you don't have to do this, but I would do this as well. Go to Style and uncheck the basis and uncheck the background. You can make the upper and lower bands a little thicker if you want to, if that makes it easier to see, but you know, you can do that. You can color them red if you want to, or you can change the Kijun-sen to blue. I mean, whatever works for you. Excuse me. the point of this, because now we're talking about the break, is we want to observe a time when the candlestick breaks the upper or lower band. Okay, that's often going to be the first or second thing that we look for. All right. The next indicator you're going to want is the detrended. It depends on how it's some software call it the detrended or just the detrend price oscillator. That's what we want next. All right. And this is the last thing we're going to add on our screen. And by default, it's set to 21. We want to change that in the inputs. We want to change that to 7. By the way, if you guys have any questions as we're going along, please type them in there. If I'm going too fast, let me know. And so we're going to go with the 7 period moving average. And you can change, again, you can change the aesthetics of these as you want. I like the 0 line to be thick and not a straight line. I don't like it to be just zeros, but we want the 0 line. Okay, so here are the steps. The first thing we want to do is identify first, is there a gap in between the candlesticks and the Kijun Sen? So for right now, I look at the pound. Yes, there is. And then I want to know, has there been a break of the Keltner channels recently? Yes. Okay. There's a gap between price and the Kijun Sen. There is a break below the lower band of the Keltner channel. And then I want to know if there's an extreme. So this is the part that's a little more subjective. Okay. Once you have your detrended oscillator on your screen, I want you to do this exercise. Okay. Double click somewhere on the open space of the detrended oscillator. So you get this, right? By the way, this doesn't matter what time frame you're using. You're going to have to change whatever time frame you're going to execute trades on. That matters. But for this exercise, it doesn't matter. So I'm looking at the hourly chart for the pound. I'm going to scroll out. And what you want to do is eyeball where things look like there's a lot of support or resistance. You can place several levels there. So if I start from the top here, I see, okay, well, there's some levels here that have been hit before. There's a quite extreme, but there's not a lot of, I mean, you got to think of it this way. The areas you're going to identify as extremes are basically trading opportunities. The fewer you have, the more likely the positive expectancy of that trade is. The fewer you have, the more you have, the more choppy your profit ratio is going to be. But I'm just kind of eyeballing this a little bit and looking at some extremes. And then I'm going to do the same thing below because I want to get an idea of, okay, just a rough idea. Just kind of eyeball that, all right? And that's basically what you're doing is eyeballing. We eyeball a lot of things on this because that's the point. That's the point. All right. Once you've done that, double click out. And what I want, oh yeah, sorry, no, go back, do what you did. Now, where you found these extremes before, take your vertical line tool. Here's a little trick on TradingView. I love that TradingView does this. There's an option here. If you see on my screen that there's the magnet, and then there's the stay in drawing mode. When you stay in drawing mode, what happens is after I place a vertical line, I don't have to go back to check it. I can just keep clicking until I right click off of it. So what I'm going to do is place a vertical line where these extremes are at. Change the color to black. And I'm just going to mark some of them because this is kind of my back test. Just kind of zip through here and just find some examples. And they don't, I mean, I'm picking ones that are like kind of out in the outliers. I should probably look at some that are, you know, maybe in the middle there. Hit that second line. Depending on the instrument, I mean, depending on how long you've been trading, you probably would, if you choose to use this, you should be, you kind of just get a feel for how the instrument that you trade moves and what is considered an extreme or not. It's just something that kind of happens with years of trading a single instrument or several instruments. You just kind of become, I don't know, you get a feel for them, so to speak, if that makes sense. Okay, so now I've done that. I've put these vertical lines are not part of the strategy. They are just a reference for me to check to see if things, you know, if there was an opportunity or not. Okay, so again, first thing that we do is identify if there was a gap. Okay, and I'm looking at the pound right now on the hourly chart. All right, there is a gap. Second, was there a break of the Keltner channel? Yes, there was. Has it hit an extreme? Yes, this has. Okay. The entry signal is going to be when the detrended oscillator crosses and closes above the zero line. Okay. So, I mean, I don't know what price level that's going to be at. It's 824 right now. If it moves up a little higher, you know, then you could then you could go long. I mean, again, but looking at the pound on the hourly chart, looks like this might cross here fairly soon, and all the other criteria to go long has been met already. Okay, so that's just for the pound. But let's look at something in the past that happened. So let's look at all right. Let's look at this trade idea back here. All right, is there space? Is there a gap in between the candlesticks and the Kijinsen? Yes. Okay, that's the first thing. And sometimes you might like to do this with by checking things off. All right, like just hiding things and going through them step by step. So the first thing I'm always looking for, is there a gap? Yep. Okay, I see a gap. Next step, put on my Keltner channels. And you should make a practice of this, okay? You should make a practice of this by only adding these things as the prior conditions are true. So there's the gap. There was a break, yes. And what I like about this strategy that I developed is that it gives you a lot of heads up, okay? It's a good way. I learned how to train myself to wait for the market to come to my criteria instead of me trying to force the market, if that makes sense. Okay, and this is not a 100% foolproof thing. This is not a it's something you got to try out for yourself. I make no promises or guarantees here. So it did break the Keltner channel. All right, next thing is, has it moved to an extreme? If I put the detrended oscillator on again, yeah, I know there's that an extreme. And I'm using past price. I'm using something that's already happened, so this makes it look like it's, oh my God, this is like the Holy Grail. It's not the Holy Grail, okay? The trade is when it crosses and closes below the zero line, which is the black line here. Now, if I would have entered short, I mean, this is a horrible time of day to do this. I would not have taken this because it's 8 o'clock at night. I generally don't take trades in foreign currencies until after midnight. But it would have turned into a profitable trade. Mostly probably a flat trade. But, you know, as you get closer to, in the foreign currency markets at least, when you get closer to the 3 a.m. Eastern Standard Time, things pick up a lot. And so your extremes here are going to tighten up a little bit just because of the participation. Actually, I should just pause for a second and ask if anybody has any questions. Everything okay? You mean like, am I okay or everything's okay on your end? Okay, good so far. Awesome. So, I mean, is this making sense? Is it fairly simple to understand? I mean, it's people have different. Everybody I've taught over the years, they have different knowledge. There's a big difference between somebody who's new to trading and somebody who's new to trading. There's a significant gap as far as okay, very simple, awesome. That was the point I was trying to do, is to show you something that is simple. So for foreign currencies, I mean, this is something that you probably only want to execute, between midnight Eastern Standard Time and probably no later than 2 p.m. Eastern Standard Time. I mean, that's a little bit. I mean, let's look at something more for anybody who trades the futures market. Let's look at like let's look like a 5-minute chart of the NQ, which is the NASDAQ, the NASDAQ futures contract. Okay, so if I'm looking at the 5-minute chart, a lot of these big spikes here, these are all like at the open outcry or the open of the market. So you're gonna want to, like, a lot of times with this strategy, I learned just ignore that part of the day. But I'm just gonna kind of mark off some extremes here. So if I'm looking at the 5-minute chart, I want to know, is there a gap? Yeah, there's a gap. Did it break through? Yes. Is it at an extreme? Sure. My long entry would have been at the cross above the 0. And depending on how many points you're targeting, how many ticks or points, that's how they measure in futures market, are ticks and points. However many ticks or points you want, I mean, there's definitely their 5-minute chart. You're going to want to be, not too picky. Zoom over here. This is this was today, later on in the afternoon. I wouldn't consider that a gap. I probably would have missed out on that trade if I was doing this on the 5-minute chart. But I don't trade on 5-minute charts. I'm just saying, if I did, something. I don't know if I say that or not. Something you could do, depending on the market you trade, like cryptocurrencies. All right, cryptocurrencies have wicks or shadows, whatever you want to call them, all over the place. So for markets like Bitcoin, or not Bitcoin, let's talk about like altcoins have a ton of wicks. Bitcoin has a ton of wicks. So let's look at like Cardano. All right, it's a horrible example because it doesn't have as many wicks as I thought it would have. But okay, well, let me think of something newer, like Quick Shot that was just added to. Oh God, not that. Oof. IoTex, no. No, actually, great example of something. So cryptocurrencies are full of crap like this. These huge spikes followed by these pullbacks and more spikes. These are very tradable with this system. Okay, if you're smart, they're very tradable. I'm trying to find a crypto that has a ton of wicks on it that it's kind of annoying. The point I'm trying to make is that identifying the open space can sometimes be difficult to spot visually if there's wicks involved. So what you can do is you can double click on those candlesticks and just uncheck the wick. All right, just uncheck the wick. All right, the bodies of the candles are what we're focusing on here. I mean, if there's a wick or a shadow above that breaks the Keltner channel, that's fine. That's adequate. But when we're looking for that open space, sometimes getting rid of the wicks makes it a little easier to spot. So I mean, for Litecoin, for example, I don't know if the wick pierced that or not, but Trying to think of a spot. So, okay, right here. There's a gap in between the Kijun-sen and the candlesticks right here. Okay. There was a break below. By the way, this is the hourly chart. So if you're looking at this, if you've got another job or something, you're looking at this at 6 in the morning, you're like, oh man, okay. Is this something I could look at like at 8 o'clock? All right. I know there's a gap. I'm waiting for something to break below. The gap is true. The break broke. Now what I'm looking for? I'm looking for an extreme. Is that at an extreme? Sure. Yeah, this has been a place that has had support before. Okay. Now what am I waiting for? I'm waiting for the cross above the 0 line. All right. There's your entry at the close, 141. And then, yeah, it would have turned out profitable. Stop loss. So the stop loss, there's a couple ways that you can identify the stop. That is to place it a little bit below the Kijun-sen, or you can use the Keltner channel itself, the band itself, as the stop. All right, I think that's a little bit tighter. Using the Kijun-sen on an hourly chart, maybe not so bad. On a 5-minute chart, you get whips out all over the place. But yeah, that's how you can do it. As far as profit targets are concerned, I think those should be predefined before you enter a trade, and you should have a fixed. If you're trading underneath a daily chart, your profit targets should have, and it's just how I view it, is that they should have a fixed amount. Don't get tempted to ride things for as long as you can, or get worried. Just have a fixed amount. So it's whether it's a 20 tick, 20 point, 20 sats, 20 pips, whatever it is, that is your fixed amount. If it's Litecoin and you're trading this with leverage, and your target is $5, that's your profit target. If you'd entered at 140.69, you're getting out at 145.69. All right, that's it. And it's easy to look at those and go, oh my god, I would have gotten so much more. But yeah, when would you have exited? So Litecoin right now. Let's look at this chart, because this is something that would fulfill. Let's look at this Litecoin chart right now. It is at an extreme. All right, when I look at the hourly chart in the past, I mean, the last time Litecoin on the hourly chart was trading at this level was back in June of 2021. Is that an extreme? Oh, hell yeah, that's an extreme. All right. I know there's gap. There's an extreme. It touched this level here. The entry actually would have happened already, like this, but this is still valid. Would have entered at 166.32. Let's just kind of put a little horizontal array there for a second. I'll do something on a 5-minute chart as an example. I'm going to find a crypto, do something that's as close to live as possible. Ethereum. Okay, so Ethereum, no. Bitcoin. Cardano's got a good setup for a possible short entry. There is a gap between the candlesticks and the Kijun-sen. It has breached the Keltner channel. Is it at an extreme? If you see something like this and you look back in the last 40, 50 periods have not been trading at that range in the detrended oscillator, you're at an extreme, okay? So what I'm waiting for here is for a cross down below the 0 line. All right, that's what I'd be looking for. Sure. So very simply, this is because this requires a lot of active trade management. Something you can do here is basically this, because these are the kind of things I do if I'm looking at my chart live and I see everything here is fulfilled do a short entry. I'm waiting for what? For a cross below the zero line. At least in TradingView, you can right click on it, add alert, and I want it to alert me when it crosses below zero. When it crosses zero. I mean, you could keep this open in perpetuity if you wanted to by saying once per bar close, then you're going to get an alert every time it crosses, the detrended oscillator crosses above or below. It's going to get annoying. It's a 5-minute chart. But for right now, I just want to know when it crosses below. Let's just say this is what happened, okay? There it goes, short position. Let's just say I entered the short there, okay? I'm going to use the Keltner channel as my stop. All right. And then there's a couple things you can do to identify profit targets. And this kind of gets into a little bit of more active trade management, but if you're trading on a 5-minute chart, pull up the daily, figure out where the last daily open and close was. So not the current, but let's look at there's the open from yesterday. There's the close. Where was the prior high? Right there. What the hell am I listening to? Okay. There's some like brown jug whispering in my ear, whistling in my ears, creep me out a little bit. Back to the 5-minute chart. So here's the daily. This was yesterday's open, the close. I'm probably going to put the profit target near that open. If I knew what the high was or the low was, yesterday's low was down here. 5-minute chart, you're going to kind of want to keep profit targets and stops, be cognizant of the prior trading range, prior day's trading range, as far as where the open, close, highs and lows were at for day trading purposes. But if you're doing something like the hourly chart, so if we're looking at the hourly, this is a good example on the hourly too for Cardano. So the hourly chart, is that an extreme? Yeah, I don't even have to plot it out. That is an extreme. Okay. It's breached the Keltner channel already. I already know that. So I would be waiting for a cross back down below the zero line. Let's say that happened down at 181.66. My stop would be that Keltner channel. My profit target, if I want it to be, would be the yesterday's low down here. If you wanted, and then when it moves into profit a little bit, move your stop to break even or slightly into profit. Does it kind of make sense? It's hard for me to create. That's just something I've learned through 8 years of teaching, is that you can give people stop losses and profit targets, but they're not going to follow them. Plus, if any of you are profitable traders, you know this, that a person's risk management plan and their intra-trade management is a very personal decision. It's hard to create a risk management system that it's like trying to find a shoe that fits everybody comfortably. I mean, everybody's a little different, and I don't know everybody's risk tolerance. So, but these are, for day trading purposes, keeping things within the bounds of the Keltner channels and within the bounds of the prior traded ranges, closes and open of the prior trading day. I think that's the safest thing to do. Maybe not the safest, but I think it makes most sense. Does that help a little bit? I mean, there's other things and other levels that you should be aware of too. So, if I'm looking at Cardano, I'm just gonna hide everything on the screen here. If I'm trading Cardano, is that okay? This chart. This is why in cryptocurrencies I like to get rid of the wicks, because it just makes it a little bit more clear. But when I'm looking at trading something like this, I mean, you should have your fib retracements drawn. Yeah, and I wouldn't. And this may sound anathema to some people, but if you're still trying to become a profitable trader, or if you're spending a lot of time trying to figure out if this trade is worth it or not, oh my gosh, my risk to reward is 1-to-1, I can't take that. Fuck that. Pardon my French, but like, focus on making a winning trade. All right, focus on that. So what if the risk to reward ratio is 1-to-1? No big deal. Focus on taking a trade that can become profitable. If your setup is good and the risk to reward is still 1-to-1, big deal. If you're always looking for a 2-to-1 or 3-to-1 in your day trading, you're going to miss a ton of opportunities out there, and you're going to be your filter's way too tight. Just make it just practice making profitable trades. That's successful trades. That's the most best advice. IOTEX. Why is it such a popular crypto? I did a video on it and it's gotten a lot of views, and it's just added to Coinbase. Is that why it's so popular? I mean, I know nothing about a lot of these cryptocurrencies. I just look. I'm a chartist. That's all I look at. But anyways, going back to the fib levels, if I'm looking at this, I would like to know what are the important Fibonacci levels over a certain range. Because a lot of those macro levels and technical analysis you're going to want to be aware of. You should have those on your chart too. So you don't want to just add these and that's it. Have your higher time frame levels drawn. I like to do this in these videos because then people, I'm going to show you how to draw Fibonacci retracements quick, the right way. Okay. This will be, if you take anything else out of this, you can take this away from it. But let's look at Bitcoin. I wonder that's so loud. Let's look at Bitcoin, for example, and I'm going to bring back the wicks for this. Hide everything else, okay? So most of you probably, here's another thing. If your chart for Bitcoin looks like this, you are doing it wrong. Okay? Instruments like Bitcoin, the S&P 500, the Dow, the NASDAQ, you need to look at them from a measure of proportion. All right. So what I mean by that, logarithmically. So on the scale chart here, right click on it and hit logarithmic. Okay. So now you get a much better view of how Bitcoin moves. Okay. Because if you don't do this and you're looking at this, it doesn't look like Bitcoin did crap for 8 years. Okay. It doesn't look like it did anything. But if you look at it as a measure of proportion, then you start to see things. Then you start to see patterns. Then you start to see how that, like, the art of technical analysis, and how in technical analysis we view markets as natural living things, as non-random, because you'll notice things like this thing here. I'm going off on a tangent. This. To some degree, what's going on over here. A little bit of that. you'll see these things pop up all over the place. All right. But fib retracements. A lot of you probably draw them like this. You look at the extreme low, right? Then you go to the extreme high. Looks right. Yeah. Sometimes it works out fine. Or you look at, do the weekly chart. Probably draw from this extreme high, the all-time high, down to the COVID crash low. Looks okay, right? Or you could draw from 2018 low to the 2017 high. Looks all right, right? This is not how we draw Fibonacci retracements anymore. And professionals do it differently. We do it the way that Connie Brown showed in her 2008. Okay. Do I have it up here? No. I thought I did. I have her other book. One of her other books, but Technical Analysis for the Trading Professional. Oh, wait. I don't think it's in that book. No, it's in her book called Fibonacci Analysis. Yeah, it makes sense. That's the title. Anyways, we don't draw from extreme to extreme anymore, okay? What we do draw to, we start at an extreme. I'll get rid of these other ones. It's just confusing. What we do draw to is we find that extreme. So if we're going to draw from the low to the high, we look for what's called the strong bar of the move, all right? That is the bar that has the most range attached to it. And if you can't identify it visually, you're going to have to measure it. So, and when we're measuring it, like something like Bitcoin, we want to measure percentages. So there's a price range tool, okay? This looks like a pretty big bar. Measure from the low to the high. What is that? 54.1%. Okay, here's another big bar. 54%. That's a wider range than... wait, no, it's not. They're pretty much the same. That was 56.85%. Okay. Now the high of this swing is up here, but I look at that candlestick. That's a 78% move. I without even having to do anything else, I know that that's the strong bar. And do these on the weekly. So my retracement's gonna be drawn from that low to here. Okay. This is one of those things where if you probably wouldn't see much of a difference, but you're going to notice there's a slight difference between, if we get rid of the wicks here, you'll probably see it. Between the difference between the open and the close of where this is at versus this. That versus this. That versus this. It's slight. It's not that major of a difference. But let's look at the swing over here. Let's look at this swing. Now, Connie made the point that, you know, this is especially true. This is what makes cryptocurrencies a little tricky Fibonacci-wise, is that not all of the extreme highs and lows with these wicks are important, especially something like this. So what Connie suggested in her work is that you look at the high of the next bar. So for example, in the COVID crash low, we would not draw to this or off of this low. We would use the low of this next bar just as a frame of reference. So we wouldn't draw from here. We'd start off with this high, all right? And then go down to not that low, but the strong bar. So we have to find the strong bar of this move. Again, we're going to measure percentages. Is it this one? It's 31%, 31.98%, 36.27%, and I already know from experience that is the bar. So this is going to be a little weird because most people are used to doing this, drawing from there down to here. We don't. We're using the strong bar. Sometimes the strong bar is in the middle of the move. Okay? Sometimes it's the next bar. Sometimes it's the same bar. But here's the strong bar of the move. Not down here. It's over here. All right. Does that Does that kind of make little sense? And the reason I'm telling you this is because the retail industry wants you to keep drawing these fib retracements the way you've been drawing them from extreme to extreme. There's a reason you've probably been very frustrated. If you use Fibonacci retracements or extensions, there's a reason you've probably been extremely frustrated trying to use those. It's because you're being traded against drawing the way that they want you to keep drawing them. The way that you're drawing them from extreme to extreme is incorrect. It is almost 15 years old. But if you do it this way, you're going to notice things are a lot different. I mean, let's look at a different market. Let's look at Aussie dollar, US dollar. All right, so let's trying to think here. Yeah, we could use this. So there's several swings that exist in here, and again, if I'm going to draw from low to high, I'm not going to use this one that looks pretty anomalous, this big low down here. I'm going to start with this next low. Now there's a strong bar here. Okay. There is a... now, foreign currencies you measure in pips because price doesn't move that much. 2.6. Sorry, that's 186 pips. That's 173. 204. How do you use Fibonacci? They're between levels, but the main purpose is to identify where something may find support on a pullback or resistance on a throw. Well, I would call them pullbacks. For example, let's just use Cardano again as an example. So Cardano's had this, pretty big move, and let's use like intraday. Let's just go to the hourly, and let's pretend we didn't know anything that happened after, that high over here. All right, so I know that the swing high was here. Not using that one, but here. I know the strong bar of this move, just by eyeballing it, was here. All right. And so there's my 382, my 50, my 618. The other ones that you could use are, I don't really use them that often, 786, and then one that is not ever put in here, the 886. So basically, the Niv, I don't know how to pronounce your username, the Nivjiv, just basically what we would look for is that the 382 level at 177, if price comes down there, that's likely support. So is the 50%. That's most likely a support. And the 618 at 171 is the next most likely support. 50 and the 50% 618% retracements are the strongest. But I tell you what, that 886, things bounce off that like violently, like a hockey puck. So if we hit the play button here for the market replay, we're likely to see these prior fib levels act as important areas of support. Not especially useful on that swing, I guess, but I mean, I think just the point, though. It's on the hourly chart. I mean, this could have... Strong bar was back over here. Break that down to a 5-minute chart. This is where you use other oscillators like the composite index, RSI. think you can kind of see how things get a little bit bound and stuck up against some of them, but that's in a nutshell how you use fib levels. One of the ways to use fib levels. I'm doing I think next week I'm doing one on Fibonacci's, basically what I'm doing right now, but got way off topic from the, but are there any questions about the gap, break, extreme, and cross strategy? I'm going to ask that you don't just dive in and start using it right away. Definitely, do your own due diligence. Oh, no worries. Do your own due diligence and check it out if it's something that you would find useful or not. Yes, yep, it's the multiples of 2. Yeah, as far as the colors don't really matter. That's something that you can figure out on your own. Like Cardano's this daily chart of Cardano is a good example of one that could turn into a good trading opportunity for the short. We looked at the pound on the hourly chart, I think. Yeah, we looked at this one as soon as it crosses above the 0 line, that would be the entry. And when you're to answer your question about profit targets, when you're day trading, be cognizant of where that Kijun-sen is at, because the Kijun-sen is it's like the bread and butter level for day trading. So let's say this crossover of the 0 line occurred like now. My profit target here would be pretty I would watch it closely, because the Kijun-sen is a very strong level of support and resistance, and so I wouldn't want to hang on to it too long, because there's a high chance that price will go lower if it comes back up here. But if there was a crossover of the 0 line and I'm within a couple of pips of the Kijun-sen, that means we're probably going back above it. So just take notes when you're doing your own, going back and looking at the instruments you trade, and you're looking at how, if this is useful in your own analysis and trading. Take it, use a word pad, or I write by hand still when I keep my trade journal. I just remember things better that way. But if you're going to do this, write down or record at least, saying that, well, there was a trade set up on August 11th at 12 p.m. and there was a gap, there's open space, there was an extreme met, there was a break, and I waited for the cross down to occur, write down the level, make a note of how far away it was from all these different levels, and yeah. But so this video will be up as soon as YouTube decides to finish publishing it. And if you guys have questions about anything that we've gone over in this video, just drop them in the comment section on YouTube, and I will try and get back to them. I might get distracted and totally forget, but I will try and get back to you with an answer. So thank you all for watching, and have a great weekend. Bye.